Right, so the Chinese market reopened after 7 days of a holiday, and then let's have a look at how did the Chinese market fare before going into this kind of holiday. Well, the CSI 300 index surged around 25% just in a week's time, and the Hang Seng index surged about 9% during the time when the Chinese markets were closed. So this was a very good start to the Chinese economy in the morning, but we'll also look at how the Indian markets did. You know, the Indian benchmarks however weakened in the same period. Nifty was off around 6%, 5.5% to be precise, from life highs made on 27th September. But then we'll have a look at the kind of FI selling that happened in India. Well, FI sold over 30,000 crore from the Indian equity markets in October. So this is largely looking out to be like the FIs are taking their money out of India and then, you know, putting into Chinese markets. But then if we can roll over to the next slide, we'll see that what kind of reforms were made in Chinese market. Well, but before that, let's move on. Let's talk about the Golden Week holiday. Well, October 1 to 7 were closed for the Chinese markets because of the Golden Week holiday, as I mentioned. And there were the latest reforms. There were 3 reforms that the Chinese economy, the Chinese central government made. Number 1 is that they lowered the reserve requirement by 0.5 percentage point, and this boosted the liquidity in the Chinese market. This was followed by the benchmark interest rates being cut by about 20 basis points to 1.5%. But the major reform was made in the housing sector. They removed the floor on mortgage rates, number 1, and they also removed restrictions on buying second homes. So this was a major stimulus to the housing market, and this also weighed on the metal index as well. The Chinese stocks actually gave up the gains as the NDRC underwhelmed at the briefing today morning. Well, the market was expecting major reforms in the meeting today, but that didn't happen and disappointed the street. Previous reforms were, however, reiterated. So that is negative is what the street believed in the morning, and that is why the Hang Seng index actually slumped down to about 7 to 8%. But let's talk about what CLSA believes on Chinese and the Indian economy. In their model portfolio, they have raised China to 5% overweight by reducing their overweight on India to 10% from the previous 20% that they have. Now, this is on the back of 3 reasons, largely on valuations. They believe that the PE discount that China has in relation to India is at 53%. The PB, that is price to book discount, is at around 64%, and it also gives 2 times the dividend yield than India. So these are positives for the Chinese economy as against India. And they also reiterated 3 key whiches, as the CLSA pointed out. Number 1 is that the market is liable to be saturated by the new IPO issuances, you know, that are coming in the Indian equity markets. Next one is that it also states that rupee is vulnerable to elevated prices. And lastly, we'll see that how SEBI has curbed the retail derivatives, and that could impact the participation of retail investors into the Indian equity markets. But lastly, let's talk about the positives of the Indian economy. Well, CLSA believes that this one is just temporary for the Indian markets, and India still offers the best emerging market growth strategy. As I mentioned, this does a temporary reduction is what the brokerage house believes. And lastly, in terms of ROE, that is return on equity, well, India's return on equity is better than China at around 15.5% versus 11% that China offers. But temporary, yes, in the near term, China is gaining at the expense of India, but this is just temporary is what CLSA believes.